Hi, I'm Mary Kopczynski, the CEO of RegAlytics. Welcome to this week's Regulatory Roundup. This week there were 1,466 alerts from 260 unique U.S. regulators. 506 had to do with coronavirus. Don't be alarmed by the uptick in coronavirus alerts. We added a few core healthcare regulators that naturally bumped up the number of coronavirus-related alerts. Our goal is to have every state and federal level agency covered by the end of the year for all industries. The regulator of the week is the Supreme Court. I'm sure most of you have been hearing a lot about the Supreme Court and rulings regarding DACA, LGBTQ, and abortion, but there are a few other subtle rulings that came out that are interesting to those of us in finance. For one, the Supreme Court issued a ruling about the unconstitutionality of the CFPB. A divided Supreme Court upheld the legality of the CFPB itself, but insisted that the president could fire the director at will. This ruling will not only affect the work of the CFPB itself, but it could undermine Congress's future ability to fashion executive agencies free of presidential influence in the future. The other big case that came out settled a 4-year dispute between the National Credit Union Association and the American Bankers Association. Basically, the NCUA is allowed to set rules regarding who credit unions can allow in their what is called field of membership, meaning customers. The ABA argued that this was overreaching, putting way too much power in the hands of the National Credit Union Association, and it would unnecessarily control the local credit unions. The Supreme Court declined to hear the case, basically allowing the NCUA rules to continue to stand. The topic of the week is deregulation. So much happened this week, I will definitely not be able to cover it all. A number of big joint agency announcements came out this week, starting with the Fed, the CFTC, the FDIC, the OCC, and the SEC. They released another modification to the Volcker rule that essentially rolled it back a little bit more, carving out certain activities that allowed formerly locked up funds go back into the market. Also, the Fed, the OCC, the FDIC, the SEC, and the CFTC, yes, a different combo, adopted amendments to the Bank Holding Company Act, which clarifies the covered fund provisions, meaning it reduces the number of entities that need to register as a bank holding company. Additionally, the Fed, the FDIC, the OCC, the Farm Credit Administration, and the Federal Housing and Finance Agency, again, new set of combos, they amended the swap margin requirements for registered swap dealers. These rulings came with, of course, a boatload of criticism saying it was an inappropriate time to allow banks freedom to blow money in the middle of a pandemic, especially money that had been carved out for safety after the 2008 meltdown. I think that if you consider the punishment of the banks in 2008 as a level, let's say 10 punishment, and over time it's been ratcheted down to, let's say, a level 7, these rulings essentially ratchet it down to what I'd say is a level 5. The rule is still there, it's just a little less restrictive. Is that good in a pandemic? Well, it is actually thanks to that punishment that we are in a far better economic position than we would have been if the pandemic had hit in 2008. But it is also the great expense of this pandemic that it actually might make sense for these banks to be able to earn a little bit more money with cash that is just sitting there available to try to ensure that they make more. So the jury's out, but as everything is in the United States, it's highly polarized. Also in deregulation, the SEC updated a reporting requirement that hadn't been reviewed for over 30 years and basically exempted certain smaller broker-dealers from some of the reporting requirements of the rules. Okay, so for those of you following crypto, there was a lot of fun stuff this week. The Alabama Securities Commission busted Corona Fever Invest, a cryptocurrency trading firm. Not only did they fail to register in Alabama for issuing securities, but they used deceptive advertisements fake customer testimonials. The SEC busted a Nevada-based company that raised $5.6 million by selling tokens that could later be converted into AML BitCoin, which they claimed was superior to the original Bitcoin with anti-money laundering, anti-terrorism, and theft-resistant technology built into the coin on their own privately regulated public blockchain. Apparently, none of these capabilities actually existed. The SEC also settled with the Telegram Group for an unregistered offering of digital tokens called grams. They had to return more than $1.2 billion to investors and pay an $18.5 million civil penalty. But the crypto news is not all bad. The New York State Department of Financial Services announced a virtual currency program with the State University of New York, where student and alumni startups can get an easier path to New York licensing. In big clarification news, the CFTC issued final guidance concerning the term actual delivery, which identified when certain types of digital assets pass from one to another. That is big news in the law. Additionally, the CFTC's Technology Advisory Committee is having an open meeting on July 16th to discuss automated and modern trading markets, distributed ledger technology and market infrastructure, virtual currencies, and cybersecurity. For those of you following cannabis, the FTC is seeking public comments from 10 of the largest cigarette manufacturers and smokeless tobacco manufacturers. Missouri busted a company called Cannabis Plus for offering unregistered securities to investors. And the big one, FinCEN issued guidance regarding due diligence requirements under the Bank Secrecy Act for hemp-related business customers. For those of you following social justice issues, and even for those of you just following straight financial news, there are some big announcements this week. The National Association of Insurance Commissioners announced a special session on race and diversity in the insurance sector. The Federal Reserve is both modifying and extending for 3 years the joint standards for assessing the diversity policies and practices of entities regulated by the agencies. Section 342 of Dodd-Frank requires the OCC, the FDIC, the NCUA, the CFPB, and the SEC to establish an Office of Minority and Women Inclusion. Additionally, the SEC Asset Management Advisory Committee announced it will hold a public meeting on July 16th to discuss data and technology and improving diversity and inclusion. For those of you following SROs, Fannie Mae announced updated renter protections and forbearance extensions for borrowers, and ICE announced that its 3 to 5 year Euro government carbon reduction index has been selected as a benchmark for a new exchange-traded fund. That's it this week for RegAlytics US Alerts. Join us every Wednesday morning on LinkedIn, and for the longer version, see us on YouTube.